Hi, everyone. Welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're doing a deep dive into SPIAs, or Single Premium Immediate Annuities, and sharing what you need to know so that you do not get locked into a contract that's going to cost you way more than you bargained for. And also, this is a part of our larger Annuities Exposed series. In fact, it's the last video in this series. So whether you make sure you check those out, we will put the links below in this video so you can check all of them out. But whether you have an annuity or you're looking to buy one or someone's trying to sell you one, you watch this video to the end because the content, this is like the ABCs of SPIAs and
right. And Michelle, we're doing this series because there's so many different types of annuities out there. They can be complex or difficult to understand. You got to know what you're buying, right? And think about this. $254.8 billion in annuities were sold in 2021 alone, according to LIMRA, which is the Life Insurance Marketing and Research Association.
And they use the word sold.
Sold. They did not say people went out and personally purchased them.
Right, exactly.
Sold. Yeah. Annuities are a big business, but they could be a great product for the right person, especially when they're customized to your individual needs. And that's why we're running this series, Annuities Exposed. Today, though, we're going to focus on SPIAs, but make sure you check out all the other videos in this series down below this description. So,
awesome. Well, if you like this content, we'd appreciate the hit that like button, and also subscribe, right? Exactly. Please. Helps us grow the channel. It really does. And also subscribe so that you never miss another video from us on how to stop being a transaction and instead become an informed consumer with a solid financial future and not waking up one day and wondering why you own something that isn't right for you.
Exactly.
End of story.
End of story.
All right. Let's start with the basics, Brian. What are SPIAs?
Okay, first of all, SPIAs, like any other annuities, they're a contract between you and an insurance company. A SPIA, like you already said, Michelle, is a single premium immediate annuity. The name explains it all. You deposit a single lump sum premium into the annuity and begin taking income immediately, usually within 30 days to 1 year of opening the account. So,
okay.
Some other names for this are income annuities or immediate annuities. And these are the simplest annuities to understand, but you still need to do your homework and read the details of the contract. So,
okay. So you mentioned one of my next question was how does SPIAs work? But you basically just told us you deposit a large sum premium into the annuity, right? And you begin taking income immediately, usually within, what did you say, 30 days to 1 year?
30 days up to 1 year. So, yep.
All right. So how are they used? Is it just for immediate income, or is it also for accumulation?
No, they're truly designed for immediate income. So versus the accumulation side of it. So a little bit different than the other annuities that we talked about that were for accumulation. This is for income. So.
All right. What are some advantages to SPIAs?
They're simple. You decide how much income you want and for how long a period you want that income. And the annuity company then tells you how much you need to deposit. This is where you want to research to find the most, to where you get the most that you can out of them. So what you're comparing is, if I deposit $100,000 today, Michelle, how much, and it paid me $1,000 a month for the next 20 years, whatever it may be, you need to research that with other companies because you might get a higher payout with a different company. So, but they are simple. They're guaranteed. When you set up a SPIA, you set up a guaranteed income stream for the term that you choose, whether it's a lifetime period or 5 years, 10 years, whatever it may be.
Okay.
And they're predictable. The income from a SPIA provides peace of mind. People love these. I see them all the time, used in multiple different circumstances. And you know, Michelle, each month that your income is predictable and you can pay your expenses without draining other assets. So
that's huge. All right. So advantages: simple, guaranteed income stream for the chosen term, and they're predictability. All right. What are some negatives? or cons?
Okay, one big negative is once your lump sum premium has been deposited into a SPIA, you lose the liquidity of it. Okay, because your payments have begun. Now there's usually no liquidity options in case you need funds for an emergency. Again, another reason not to use 100% of your assets for one product. So, some SPIAs though, Michelle, will have a one-time lump sum payout. You may be able to take some funds out, but it will change the income payouts for the future of the contract at that time. So you got to be careful on that if the company even allows it.
Sure.
So. Loss of liquidity is one of the downfalls of a SPIA today. So
what other disadvantages are there?
How about loss of control? Once your income payments have begun from a SPIA, you now have no control on that money that's coming in. The money will pay out according to how the contract was written. So if it's $1,000 a month for 5 years, and you need a little bit more, well, you can't change that contract because the contract is already written. So you lost control of that. So, and third would be loss of purchasing power. This is huge right now. SPIAs may not keep up with inflation. I don't think anything is keeping up with today's inflation. Just my opinion, but an option to offset this is to purchase an inflation or cost of living rider, which will also cost a fee. You'll have to pay a fee to an insurance company for that. Some SPIAs don't have it though. So
again, it's all in the contract.
All in the contract.
On the contract. All right. So let's talk about some SPIA payout options. Like how much can people expect to receive and what does that look like?
Yeah, well, the income amount you get is going to be based on the age of the insured, the sex of the insured, the amount of money used to purchase the annuity, and the payment option that you choose. So remember that. Everything's based on mortality rates. So remember that. Females live longer. I've never figured that one out, but it happens. So, but congratulations, Michelle. But here's some of the different payout options you need to look at. Okay. Some of them are lifetime only. Okay. Lifetime only means this is the highest payout since it's based on your life expectancy only. No payments will be made after your death. This is the one that always brings up the negative of annuities. Oh my gosh, I gave all my money to an insurance company. I pass away, they keep what's left. What if I pass away 1 month after I hand them my money? It's gone. That's true if you choose a lifetime payout. So you have to know this.
But what if it's joint? What if it's a joint with a spouse?
The payout continues for the life of both.
Okay, there you go.
Yeah, so always read the details and make sure you're signing what you want to have accomplished. So here's a good one though. How about life in a period certain? Again, lifetime payout based on your expectancy, but the payout's guaranteed for X amount of years, like 20 years, 10 years, 5 years, whatever it may be. And that changes the payout amount. So.
Okay, what else?
How about life with cash refund? Again, a lifetime payout, but if you haven't received your principal payment back in income at your death, the difference is refunded back to your estate.
Okay, got it.
So it's kind of like a return of premium life insurance policy.
Sure. Okay, are there any other options?
Yeah, how about just for fixed certain periods? Say, look, I need my payout to continue for 5 years, 10 years, 15 years. You choose that at the issue of the policy.
Okay.
And a note on this here, some individual insurers may have other withdrawal options. Make sure you read the fine print. Ask before signing, please.
Yeah. Brian, I'm convinced we need some sort of screen that pops up every time we say that. It's like, read the contract.
Read the contract. We'll get
you. Well, so what are some of the death benefit options? I mean, we talked about payout options. Now let's talk about death benefit.
Yeah, and each contract, Michelle, is different. So make sure you read the specific. Go to the table of contract or table of contents in the front of any contract and look for death benefit options. always know that and confirm it with the insurer before you sign on the dotted line. So,
Okay.
Spouses, of course, always have different death benefit options, including the right to continue the contract. You mentioned it earlier with the joint payout
Right.
that allowed that payout to continue to the spouse for the full term. So,
All right.
and make sure you get second opinions on these payout options.
Yeah.
Also, if the main insured has passed away, it may be in your best benefit to receive a second opinion. So,
Okay. All right. So are there any risks with SPIAs? I mean, well, obviously there's risks with everything, right?
there's risk with everything.
Let's just
Pretty simple. The biggest thing is the backing of, since they're backed by the issuing company, which is the insurer, your main risk is, are they able to pay their claims?
Sure.
What's their
Okay.
claims paying ability? And this is why you need to do your own research on the ratings of these companies. We talk about this all the time, DYOR. Below this video, Michelle, we'll put some links in there, a few places you can research your company. So like AM Best, Fitch Ratings, Moody's, Standards and Poor's. Each one of these companies, Michelle, gives a rating to that insurer. So it'd be like an A double or triple plus, an A minus, a B plus, a B minus. So the further you go down the scale, the more risk is involved. And what you'll see sometimes is some of the ones with more risk will also have higher payouts. And some people will make that decision of, I'm willing to take a little bit more risk here. So to get a little higher payouts, but just be careful and do your own research.
So are SPIAs safer than some of the other annuities?
Let's put it this way. They all have the same safety abilities. As far as I'm concerned, they're, again, back to the claims paying of the insurer. But when you open a SPIA contract, like any other annuity with the insurer, you're guaranteed your principal first and then your rate that you're offered to sign up. So like a SPIA is a little bit different. So SPIA will say, okay, for your $100,000 investment, we're going to give you X amount of dollars a month for X amount of period of time. Okay. And until that income is paid out, that's your risk is, am I going to get all my income back that's guaranteed to me? So, and how they do that, Michelle, insurers must belong to what's called a state guarantee association. And if that insurer defaults, the guarantee associations must pay up to what your state limits are. And the average being about 250,000. We'll drop a link below this video and then you'll be able to look up to see what your state is on that list. So,
okay. All right. So I have two more questions for you.
Okay.
First is, how are SPIAs taxed?
Oh, simple one. And probably the most common question is, okay, I'm getting this money back from this insurer. Do I got to pay taxes on it? Depends. SPIAs are tax-based on the funds used to purchase, if they're qualified like an IRA account or non-qualified like cash. So let's cover each one specifically. Let's say you have qualified funds and you used funds from like an IRA or a 401k rollover. You're going to be taxed when you withdraw the funds. It'll be considered income and will be taxed on both the principal and your interest that is earned on that account. So the whole amount is going to be taxed.
Okay.
Non-qualified funds is like cash from your bank account, right? You'll be taxed only on the interest earned. Big difference.
Okay. All right. So my last question before we wrap it up here, and what are SPIA rates?
Right now, they vary daily, and that's why you want to research it. So you can type in SPIA rates or immediate annuity rates online, and you'll have multiple sites come up with different calculators. Sometimes what you want to look at is the ones that have a multitude of options of different insurers instead of one insurance company by itself offering the SPIA rates, right? Okay. That way you can do the research, and a lot of these links will have the ratings of the companies and help you make that decision. Again, if you're looking at one or you're looking to do a SPIA, drop it below, drop some information below here and let Michelle and I do some research for you. So.
Yeah, we want questions. Please send us what you got.
Please.
All right. On that note, whew. All right. We've officially closed the Annuities Exposed series. Yes.
Honestly, we hope it actually is to your benefit because
Yeah.
these are very complex products, and it was all about you guys. It was the questions that we received over the last year now that we've been doing these videos is that more questions came about annuities than anything else. So
Yeah.
we want to make sure we're doing the right thing for you folks.
Absolutely. All right. If you like the content of this video, hit that like button and make sure to subscribe to the channel so you don't miss another video from us. And one last thing, do check out some of those other links in the Annuities Exposed series. Again, they don't get taken to the bank and don't wake up one day and realize that you've been sold something that you do not need.
Right.
All right. Thank you, Brian, so much. And thanks, everyone.
Thanks, everyone. Have a great day.